All right, I think we'll go ahead and begin. This is Brian Lysing with Financial Brokerage, and this is the webinar on refinancing mortgage insurance, a new look at an old concept. I'd like to thank everybody for joining us today. If you have questions, they must be typed, and that can be done at the bottom of your screen. We'll get to the question and answer period at the end of the webinar. I expect with questions and answers, this may go as long as 30 minutes, but we'll try to keep it short and sweet. I know your time is valuable. Would like to thank everybody for joining us this morning. This webinar came about in part because we have seen record low interest rates the last few years. I think last spring, I think we hit an all-time low, and what that means is it's very easy for people to refinance their mortgages. They can get a much better deal. So we've seen a lot of refinancing happening, but when those people refinance their mortgage, how many of them decided to refinance their mortgage life insurance, the policy that covered that mortgage? A lot of people probably haven't. So we're going to explore some ways this morning that you can help those folks to save some money on that life insurance policy, or maybe even provide them with money, ways to utilize that policy without all the inconvenience of having to die first. So let's dive in here. And I guess I already mentioned this, interest rates have hit all-time lows. I saw a statistic a few weeks back that the United States is on pace for 5 million home sales this year. That's potentially 5 million new customers, new clients for you to get in front of. And we've also seen over 3 years of positive job growth. So this whole mortgage term insurance market used to be really big a few years back. A lot of folks made a living selling just mortgage insurance. And I think that's really on its way back now with all the new home sales. More people are working. They've got some cash flow now. And not only are they buying homes, but they've got the extra money to pay for the life insurance to cover it. And we all know that a mortgage on a home is the largest source of debt for most Americans, and paying off that mortgage is one of the most common reasons people buy life insurance. The other thing we typically look at is income replacement, but then it's the debts. And what's the biggest debt they have? It's their mortgage. So this is a big need. If this is all you sold on, you could make a nice living off of this even if you didn't do anything else. Now, the typical solution, this is the old-fashioned sale, so to speak, that we'll be sort of using as our control. If your client borrowed $250,000 on a 30-year loan, you could offer them a $250,000 30-year life insurance policy, and that would fulfill their need, right? Well, is that everything you can do for your client? Well, we're going to explore some other things that might be able to help them. What if you had a client, they were in that situation, but they're on a really tight budget. They need to save some money. The price you gave them just is a little too high. Are they going to go without coverage? Are they going to look at somebody else, the agent down the street? We're going to explore some ways that can help you get that business. What if your client was just as concerned about paying the mortgage if they got sick or injured or unemployed? There are some ways to do that. And what if your client decided they'd really like to have the ability to pay that mortgage off early? Well, there's a way we can help them as well. So what we're going to do is explore 3 things here. One are ways to save your clients money by lowering premiums. Another thing will be to provide your clients with money through living benefits. And the third type of policy will be able to make your clients money and help them pay off that mortgage early. So starting off with lowering the premiums, we'll look at 2 different concepts here. One is the new decreasing term life policy, and the second item will be laddering term policies. Now, decreasing term, this was a big concept years ago. The way it works, if you're not familiar, is that as the principal of your mortgage decreases, your life insurance face amount will decrease at the same rate and always match the amount that you owe on the mortgage. And people thought that was a great deal. They said, hey, I don't want to pay for any more insurance than what I really have to. And, okay, well, we'll give you what you're looking for. We'll give you just the same amount of coverage. Well, premiums were the same throughout the life of that term contract, but your coverage decreased as you went along in years. After a while, it came to a point where a person could actually purchase a level term life policy for less than the decreasing. So these products sort of went away. But we've got one company that makes it possible to do this again. If you've got a client who's dead set on not paying for any more coverage than what they absolutely have to. So here's our assumptions that are going to go into the design here. We're assuming a 30-year mortgage at 3.5% interest, a person who is preferred plus, 40 years old, a male, the low price 30-year term. This would be the old-fashioned sale. SBLI came up on top when I ran the numbers, and what we're going to compare that to is this custom choice UL from Protective Life. It's their term look-alike UL, and this is what you can utilize to mimic the old decreasing term. So here's how it works. If we look at our principal balance of $250,000 in our left column there, we can see that going down. I plugged it into a calculator that would tell us what our balance is each and every year. Now, the traditional sale to cover that $250,000, we'd buy a 30-year term. It's going to cost our client $337 a year. Probably not going to break the bank. But what if they said that's too much? I don't want to pay that much for my coverage. Here's what we can do. We can get them the 20-year plan from Protective. It looks like a term, but in year 21, what they're going to do is allow your client to continue paying the same premium they've always been paying. But now the face amount is going to start to decrease. And I've figured it out so that our face amount will always be just about equal and usually greater than our remaining principal balance. So if we have to start out at $260,000 to make it work, and year 16 we still have $260,000, but in year 21, we're at the end of our 20-year term period, we drop down to $106,000. And if you look over to the left, that's still more than enough to cover the principal balance of $103,000. Year 26, okay, we've got 46 grand, principals 50. I think they can make up the extra 3,500 somewhere, and we still have coverage even when our principal balance is down to nothing. Now, by doing that, you're giving the client what they want. They don't have any more coverage than what they really need, and we've saved them $100 a year. $227 is the premium. Your competitors may not be taking the time to do this, and guess what? You're going to get the business. Now, we can go a little further with this. The far right column assumes a base 15-year policy. I had to bump the face amount up to $300,000 to make it work, but there was never a widow or widower who thought they got too much coverage. So let's not worry about that. But in year 16, when it drops, it's down to $190,000, still more than enough to cover our $148,000 we owe. In year 21, we're down to $109,000. Hey, we only owe $103,000, so we've got it covered. In year 26, we're just about $500 more than what we owe in coverage, and then we still have coverage all the way to the end of that mortgage. And we saved the client a little bit more money. Now we're down to under $200 a year. And remember, the competition, all they can show is $337. So we've saved the client probably about $150 a year just by utilizing this method here. So it's a really interesting concept. It will not work in every case, but when it does, it's really a beautiful thing. Now, the next concept we'll look at that you can utilize to help your clients save money on their mortgage insurance is laddering. This is something that banks do all the time with CDs. We're very familiar with it as it applies in that arena. But why not apply the same thing to life insurance? And what we do, instead of taking a big lump sum and having the coverage all last for the same length of time, we're going to chunk it up into little bits and pieces of various term lengths. And the illustration here really makes that more apparent. We're going to use similar assumptions here, same male, 40, preferred plus. This time, though, we're upping the face amount to $500,000, and you can see the carriers we utilized there. And I simply picked the best price carrier in each category to make this work. So here's what it looks like. We've got our principal balance on the left column there, starting out at $500,000 and then decreasing over time. I plugged it into an amortization calculator to figure out what the client's going to owe on the principal each and every year. And then we've got the total coverage, and the total coverage is always going to be either exceeding or just about at the amount we owe. Traditional solution for this, the 30-year term for $500,000, client pays $615 a year. Again, probably shouldn't break the bank, but what if they say that's too much? I'd like a little bit lower premium. Here's what we can do. We can get them a 10, 15, 20, and 30-year term policies, and they'll have all four of those in force for the first 10 years. That gives them $500,000 of coverage. We pay a little bit more in the early years, but here's where this starts to work. In year 11, we've paid off a little more than $100,000 of the mortgage. That 10-year term drops off. Now we have $400,000 of coverage. We owe $373. Our premium has also dropped down to $586. So we're already saving people some money here. It happens again in year 16. Another policy drops off. We still have enough to cover the principal, and our premium is lowered once again. Where this really makes sense is when you add up the premiums over the 30-year time period. Traditional method, client pays $18 grand. With laddering, they pay $15,000. We've saved the clients almost $3,000 over the course of 30 years just by laddering their coverages here. And you can do this for other life insurance needs as well, income replacement or what have you, but this is how that would work in a mortgage example. So those are the two methods to help lower the premium when you're dealing with mortgage life insurance. The second item I want to look at here is utilizing living benefits for our clients. You know, it's you know, not always good or not something a person wants to think of when they purchase a life insurance policy and they realize that, you know what, I'm never going to benefit from this. It's for my family, and hopefully they love their family and they're okay with that. But, you know, we've all come across some grumpy people that seem to just be more concerned about themselves than they are about others. And actually, all of these riders, these living benefits, can help out their family members as well. So we'll take a look at them one by one. These are all designed to help pay that mortgage bill when it comes each and every month. If your client has not passed away, let's find a way to utilize that life insurance policy to help them in other instances. So why are living benefits important? I got these statistics from our friends over at Assured Life. They shared with me that 60% of all foreclosures are due to a medical condition. So I know we want to cover the mortgage in the event of a death, but I mean, look what really happens here. Most foreclosures don't happen because someone has passed away. They become sick or injured and they can't work like they've been used to doing. 4 questions that can really help you make this sale when you're in front of somebody. Just ask them, has anyone you've known had a heart attack, a stroke, or cancer? Everybody's going to say yes to that. Was it expected? Nobody expects these things to happen. Did it cause financial stress? You bet it did. And would a check for $20,000 or more have helped out? Absolutely. There won't be anyone who's going to tell you, no, that wouldn't have helped at all. It's every little bit is going to help. So here's how you can help your clients. One is with a disability income rider. How these work is that they will pay the insured's mortgage bill if the client's unable to work due to an illness or injury. Most of them cap out at $3,000 a month in benefit, and they're based on a percentage of the face amount, usually 1.5%. Most of these that we run, I see the person has requested that the disability income amount be exactly the amount of their mortgage payment. A lot of instances, you've got some leeway, and it could be much higher. There's certainly other bills that are going to be coming into the household besides the mortgage, but the mortgage is the biggie. If you can get that taken care of, a lot of times you can take care of the others. 90-day elimination period is common, maximum 2-year benefit. You don't have the flexibility you do with the traditional disability policy or standalone. A lot of these choices are already made for you, but you can certainly tack this on to an existing life insurance policy. Another rider that would really come in handy, especially if a client answered yes to some of those questions, or if they had the heart attack, stroke, or cancer happen to them. Critical illness rider can really help out. It's going to pay a lump sum to the insured if they have one of those major medical events happen to them. Organ failure is included, severe burns, loss of limbs, etc. These all work a little bit differently depending on the carrier. Some will reduce your death benefit by the amount paid out early. Others will keep the death benefit intact while making additional payments to the client. There's different ways to work that. A few carriers have also added a long-term care rider. And what happens if your client is hurt in a car accident? Not only can they not work for a while, Now they can't take care of themselves. Their health insurance policy isn't going to cover chronic care, but a long-term care policy will, or in some cases a long-term care rider. We've got a few carriers that will put this not only on a universal life or whole life contract, but also on a term insurance policy, which is what we commonly see sold to cover a mortgage. And again, every carrier has a different take on how these work, but they all accelerate part of the death benefit to the insured for the purposes of needing long-term care. They all use your traditional loss of 2 of 6 activities of daily living or severe cognitive impairment as the trigger for benefits. And what's really driving these sales are 2 really important guarantees. Clients really like to know that their premiums will never change, unlike a traditional LTC policy where they're subject to rate increases. And they also know a benefit will indeed be paid out. If they need the long-term care, they're going to receive the benefit. If they pass away, their family is going to receive the benefit. So the premium dollars never go for nothing on these policies. Now, a couple other riders which are rather unique, I'll talk about really briefly. These are unique to Mutual of Omaha. They offer an unemployment waiver premium rider. Now, this won't necessarily pay your mortgage for you, but it will pay your life insurance premiums. And you want that life insurance policy to remain in force so that if you do pass away, it's going to be there to pay off the mortgage. So this has a 6-month benefit period. Your policy's got to be in force for 2 years prior to the unemployment. So if you think your job's a little shaky, this isn't the thing to go out and buy right now. It's for the person that's already been established and loses their employment for reasons that are not their fault. These benefits can be used one time. The other rider that Mutual of Omaha has exclusively is a residential damage rider. And this helps out. It helps keep the life insurance policy in force if there's been some damage to your home. So if you're talking about covering the house, covering the mortgage in the event of a death, I bet you a person would be very interested in having some extra money if there was some damage to the house. Hopefully their homeowner's policy covers this, but you know, we all have deductibles. They're at varying amounts. Every little penny helps out. Maybe they can't stay in the home for an extended period of time. Who's going to pay for the apartment bill while they're out of the house? So this can really help out in some cases. Now, the third item I want to discuss this morning with regards to mortgage insurance is the ability to pay it off early. And some people love this concept. Some people will just go out and get a shorter term mortgage, maybe a 15-year instead of a 30. But there's some things we can do to help people with their life insurance policy that covers the mortgage and also gives them that ability to pay it off early if they want to. They're not necessarily locked into the higher bill that they would be with the 15-year. They can get by with the lower 30-year monthly bill and on the side build up some cash. So they have some options down the road. And those options would be, one would be overfunding an index universal life. The other thing a lot of folks don't think about is why not use a return of premium term policy to do the same thing. Maybe your client isn't comfortable with an IUL, or they don't have the cash flow to fully fund an IUL like they should. ROP term can really fill a niche there. So an example here for using the IUL, and I got this from our friends over at Aviva. They've got it figured out to where there comes a point where the face amount of your policy, or I'm sorry, the cash value, I should have said, can pay off the mortgage, I think by year 21 in the example here. So let's take a look at that. Here's the assumptions. Using the 43-year-old standard rates. It's their builder IUL. It's one that's meant and built, intended for cash value. We're assuming a $250,000 mortgage here, and $3,600 going into that IUL. And here's how it looks. We've got a mortgage balance in year 21 of 124 grand. Our assumed cash surrender at that point is 118,000, and I think you could probably go ahead and pay it off then and there. Your client's probably got a few extra grand laying around at that point in time. Certainly in year 22, which they did not put in their example, and we know by year 23 we've got cash value that more than exceeds our mortgage balance. Now, the client does have options here. They don't have to pull that money out and pay off the mortgage if they don't want to. They can continue to leave it in the policy, let it grow. Maybe they want to use this as an additional retirement fund down the road. They certainly have options at this point in time. The other thing we can look at, I mentioned a return of premium term policy, works the same way, using similar assumptions here. I used a standard, this time 40-year-old, and I used American General's 25-year selected term. Yeah, it takes a few attempts at number crunching to get the right term length here and the right face amount to make it work. In this instance, we start off with the $250,000 principal balance and starting death benefit of $280,000. And this is where it works. The client is eligible for some money back in the earlier years of the policy there. We see 16 years into that 25-year plan, they could get 16 grand back if they want to end it at that point in time. Year 21, we're up to 33 grand back, and by year 26, our principal's down to $50,000. Our return of premium amount is $49,500. I bet they can come up with an extra $500, $600, $700 there, no problem, and pay off that mortgage 5 years early if they would like to. So to recap, these are some things that you can use to set yourself apart. You can save your clients some money by lowering the premiums on that traditional mortgage insurance sale. You can provide them with money through living benefits, or you could help your clients make some money and pay off that mortgage early. Now, some lead generation sources. Many of you may have clients already in your files, and that's the first place I would go to find prospects for any of these three concepts, especially if you have a property casualty agency. You know who your homeowners are. Call them up, send them a letter, send them an email, ask to review their mortgage insurance, make sure that everything is covered, not just the structure and the contents of their home. Be sure and ask for referrals, especially from those existing clients or anybody that you're able to make a sale to, or that you get in front of who's interested in one of these concepts in covering their mortgage. They're going to know somebody else who owns a home. They're going to know the real estate agent who sold them a home. See if you can get in front of that person as well. Could be a great source of continuing referrals for you. Be sure you're utilizing social media to reach out to folks. If you don't have a business Facebook page, if you're not on Twitter and on LinkedIn and using those resources to gather new clients and new referrals, you're really missing out, because that's the way most businesses are getting their customers these days. We've got some resources on our website at fb-inc.com that can help you understand those different resources, how to get them set up and how to use them. We also have a link to a company that can do that for you if you're willing to pay them a monthly fee. You can also get in front of folks for mortgage insurance using leads on demand. If you'd like to send out some mailers, that system will let you go through there and find your target audience. You pick the age group, the income level, make sure that they're homeowners, and then you can send out some mailers and drum up interest that way. And we have another system that lets you do the same thing via email. We know what happens to a lot of the direct mail pieces these days. Let's reach people where they spend more time, and that's in front of a computer or on their mobile device. You can do the same sort of prospecting via emails. So I'm going to take a look here and see what sort of questions we have from some folks. And keep in mind, you can type them in at the bottom of your screen, and we'll get to those here as time allows. A couple reminders here, if there are any last-minute questions. September is Life Insurance Awareness Month. Be a great opportunity to go out to all of your existing clients and talk to them about their life insurance policies. If they haven't reviewed their life insurance coverage in the last 6 months, they may be paying too much. They may have an outdated policy. Things are coming out all the time from carriers, and it's worth a second look. And if there's some other producers out there you know of that sell life insurance, they sell homeowners insurance. They're in the mortgage insurance market, or they used to be. Make sure that they know about us, they know about this webinar. We're never too busy to see who else we can help out there. If you haven't already registered, we're going to host a sales summit here in Omaha in October the 9th, 10th, 11th, and we'll explore new ways for you to reach out to clients. We'll discuss ways that you can be more effective in front of them, and also some methods to make the process easier for everybody involved. So I'd like to thank everybody for joining us here this morning for Refinancing Mortgage Insurance. New look at an old concept. If you have any questions, I can certainly be reached here throughout the day at 800-475-5555. My extension is 3371. Thank you for attending.